is a walkthrough of homework practice chapter 6 questions. I love these questions because they will help you prepare for exam 2. So question 1, Oslo Company prepared the following contribution format income statement based on sales volume of 1,000 units. The relevant range of production is 500 units to 1,500 units. So what that means is they're normally making 1,000 units. So that's not relevant though. They want us to determine what is the contribution margin per unit. So the way we do that is we need the contribution margin, which is 40,500 for my problem. That's right there. And the units would be the 1,000 units. So to get to contribution margin, that is going to equal the contribution margin divided by the sales units. So it's contribution margin per unit for my question is $40.50. And again, watch for these red words in your instructions. It's going to give you how they want things input so you get them correct. So this one is rounded to 2 decimal places. All right, now I'm still that same company, but they want to know the contribution margin ratio. So right, question 1 was the per unit contribution margin. Now the ratio. So remember to do ratios. It's the part divided by the whole. So it's going to be contribution margin divided by total sales. So I'm going to go equals contribution margin divided by total sales. And that is going to be a percent. And I believe it's just going to be the 45. You don't have to do the decimal. Okay. Same thing here, only now they want the variable expense ratio. So again, it's a ratio. So I'm going to do the part, which in this case is the variable expenses divided by the whole, which again is total sales to get my ratio. The part, variable expenses divided by the whole sales. So 55%. Now, if sales increase to 1,001 units, what would be the increase in net operating income? Round your answer to 2 decimal places. So the way you look at this is with 1,000 units, we've already covered all of our expenses and made a profit, right? So the easiest way to figure out if we increase sales by 1 unit, the net operating income will increase by the contribution margin for 1 unit. So again, that's going to be the 40,500, or you can cheat and go back and look at question 1. My units were 1,000. So my contribution margin per unit is the contribution margin divided by the units. And so that is going to be my increase in net operating income if I increase sales by 1 unit. And that is because all of our expenses are covered. And so the contribution margin then just becomes part of the profit. Okay, question 5. If sales decline to 900 units, what would be the net operating income? So one way to go about this then is to figure out the per unit. So if I reference my 1,000 units and if I anchor that, oh, whoops, I did that backwards, sorry. First, I have to reference total sales divided by the number of units, and I anchor the number of units. that tells me the per unit cost. Now, because I anchored that cell, I can drag that down to variable expenses. And I could even do this, and that shows me that I've been doing it right because my contribution margin per unit, right, I had already figured that out, was $40.50. So I can go and do this per unit times the 900 units. And I didn't anchor the cell, so I'm just going to, so that gives me my total. And then remember, contribution margin is sales minus variable. And then my fixed expenses, because that's a total fixed expense, is still going to be the same, no matter how many units I produce and sell, whether it's 900 or 1,000 or 500 or 1,500, my total fixed expense will remain 33,200. So then I just need to subtract and take the contribution margin minus the fixed expenses equals the net operating income of 3,240. Now, a quicker way would have been to take my contribution margin per unit times my 900 units and then subtract my fixed cost, right? Same number. So there's more than one way to get to this answer. Do whichever way makes the most sense to you. Okay. If the selling price increases by $2 per unit and the sales volume decreases by 100 units, what would be the net operating income? So my sales price is going to increase $2 and my sales volume is going to decrease. So my total sales for 900 units will be, open parentheses, the 90 plus the $2, close parentheses, and then times the 900 units. Now my variable expenses will change as well because I sold 900 units. So that will still just be the variable expense per unit times the 900 units. And then I can subtract sales minus variable equals contribution margin. And then again, my fixed expenses will stay the same. And so then contribution margin minus fixed expenses equals net operating income. So that quicker way would have been to do my let's see, open parentheses, my contribution margin per unit plus $2, right? Because my sales price already had covered my variable expenses. So I know that that $2 is going to go directly to my contribution margin total per unit, sorry. Close parentheses, and then multiply that number by the 900 units. And then my fixed expenses. So contribution margin minus fixed expenses equals that same number. So sometimes you can skip these steps if you know that this increased sales price will go directly to contribution margin, then you can just do that portion right there. Just remember to still subtract the total fixed expenses. Okay, question 7. If the variable cost per unit increases by $1, spending on advertising, so I'm going to put that right here, so $1 variable increase, advertising increases by 1,800, and the sales units increase by 260. Whoops, that was too many. 260. what would the net operating income be? Okay, so first of all, my new units is going to be the 1,000 plus the 260. My sales then, the selling price did not change in this scenario. So I'm going to do this the long way just because there's so many moving parts. So my first thing to get total sales will be the selling price per unit times the new number of units. Now, my variable, there was a change here. So I'm going to open parentheses, take my variable per unit plus that $1 increase, close parentheses, then multiply that by my 1,260 units. So then I can subtract, right? Total sales minus total variable expenses equals contribution margin. Now, here's the tricky part. Remember they said advertising increased. Advertising is normally a fixed expense. So this gets added to our fixed total, 1,800. Now equals contribution margin minus my new fixed expenses. So my net operating income then would be 14,760. Question 8. Break even point. So my fixed expenses are 33,210, right? And the contribution margin per unit is $40.50, and that was the answer to question 1, right? So to get break even point in units, you take the fixed total divided by the contribution margin per unit. So there's my fixed divided by my contribution margin per unit. So, and this always gets rounded to a whole unit because you can't make half of anything. Okay, so 820 units is my break-even point. Now, question 9, they want the break-even point in dollar sales. So if you recall, contribution margin ratio was answered in question number 2. We figured that out. And to get the ratio, the dollar sales, it's going to be the fixed expense because, right, that's what contribution margin has to cover is fixed expense to get to break even or a zero net operating income. So my fixed expenses are again 33,210. So to get to dollar sales, I take equals my total fixed expense divided by the contribution margin ratio. And this gets me to dollar sales. Okay, question 10. How many units must be sold to achieve a target profit of 24,300? Round intermediate calculations to 2 decimal places. So my fixed expenses are still 33,210. My target profit is 24,300. Now, my contribution margin has to cover my fixed expense and my target profit. And they want it in units, so I'm going to divide by the contribution margin per unit. So this is done by taking the, I need a parenthesis, open parentheses, fixed expense plus the target profit, close parentheses, divided by the contribution margin per unit, which again was the answer in question 1. So that tells me to get to this target profit, I need to sell 1,420 units. Okay, question 11. They want us to figure out the margin of safety in dollars and the margin of safety percent. So remember, break even in sales dollars, we figured out in question 9, and my sales are 90,000, right? My total sales. So to get the margin of safety in dollars, they just want to know what is the cushion between break even and what I made in sales. So it's going to be the actual sales or the budgeted sales. So that 90,000 minus the break even in sales dollars. So there's my margin of safety in dollars. And then they want to know the margin of safety percent. So this is going to be equal that margin of safety in dollars divided by total sales, right? That's because this is a percent or a ratio. So my margin of safety percent is 18. Okay, now we're talking about degree of operating leverage. And again, the definition of degree of operating leverage is how fast net income grows compared to a growth in sales. So you get that by taking the contribution margin divided by the net operating income. So my contribution margin is the 40,500 and which is right here. And my net operating income is right here, 7,290. So I take equals the contribution margin divided by the net operating income. And again, this is just a number and we're rounding it to 2 decimal places. So it's not a percent, it's not dollars, it's just a number. So this means that my net operating income will grow 5.56 times faster than growth in sales. Okay, so this is going to apply in question 13 now. So here's my answer from question 12, my degree of operating leverage. And let's see, using the degree of operating leverage, what is the estimated percent increase? So we're looking for a percent in net operating income that would result from a 5% increase in sales. So there's my 5% increase for sales. So remember the definition of degree of operating leverage is how fast in net operating income increases compared to the increase in sales. And so this company increases 5.56 times faster than sales. So I multiply. So equals the degree of operating leverage times the 5% increase in sales. And we're rounding to 2 decimal places. So my projected increase in net operating income will be 27.78%. All right, question 14. Assume that the amounts of the company's total variable expenses and total fixed expenses were reversed. In other words, assume that total variable expense is 33,210, right? In previous example, that was my fixed. So they're saying my variable expense now is 33,210 and my fixed expense would be 49,500, right? So they just swapped these two numbers. Under this scenario, assuming that total sales remain the same, okay, so that's the same. What is the degree of operating leverage? So again, that's going to be contribution margin divided by net operating income. So contribution margin is sales minus my new variable, and then net operating income equals contribution margin minus my new fixed expense. So I did it right because look, my net operating income didn't change because all my numbers are still the same. They're just in a different order. So I'm going to take my contribution margin divided by my net operating income to get my new degree of operating leverage in this scenario. Okay, So question 15 then is still related to the answer for question 14, right? We're still swapping those two numbers. Using the degree of operating leverage, what is the estimated percent increase in net operating income of a 5% increase in unit sales? So my increase in sales is 5%. And again, this degree of operating leverage came from question 14. So I will just multiply these two, right? Degree of operating leverage times the increase in sales. And we're rounding to 2 decimal places. So my projected increase in net operating income would be 38.95%, which is 7.79 times faster than the increase of 5% in sales.